Good afternoon. Thank you for joining us today. My name's Amy Rizzo, and I'm the marketing manager for Kelleher and Holland. And the team assembled here today are excited to share their insights with you on how advanced estate planning techniques can offer significant advantages for your clients looking to preserve their wealth and reduce tax liabilities. So please welcome three panelists we have for you today that have spent decades guiding high net worth clients and businesses through complex legal landscapes. Our founding members, Andy Kelleher and Bob Holland, are both highly accomplished attorneys and CPAs, along with nationally recognized estate planning thought leader Ed Morrow, who is our co-chair of our estate planning group. And they all bring a wealth of knowledge in trust and estate law, taxation, business planning, and asset protection. So, Andy, I will turn it over to you to get us started.
Thanks, Amy. And also thanks for everybody joining us today. We're going to have some fun and we're going to go through some great topics. So let's hit the current landscape. I'm sure a lot of folks on the call, on the webinar are aware that the current federal exemption landscape is very generous. So currently we have an all-time high $13,610,000 federal exemption for both estate and generational skipping tax purposes. And that's going to be subject to some change, which I'll talk about in a second. But we also have a $4 million Illinois estate tax exemption for our clients that are residents and domiciled in the state of Illinois. Although we're multi-state, we represent clients throughout the country, we do have to deal with that nasty Illinois estate tax. And it can be quite a challenge. The current law is focusing on the federal, because there's nothing that we're aware of that the Illinois is contemplating currently to change its law, is that the current federal exemption, the $13,610,000 exemption, is scheduled to sunset on December 31st, 2025, January 1st, 2026. It's going to sunset and decrease to $5 million adjusted for inflation. Based on our internal calculations, that's going to end up to be around $7.4 million, depending on the math that is chosen to be used. So what's very interesting about that is the sunsetting, that decrease is the law. So meaning absent congressional agreement in the House and the Senate and the future president, whomever that may be, all being on board together and agreeing, that sunset is the law. So, taking into account the upcoming elections, if former President Trump wins or Vice President Harris wins, you can make your own business judgments on whether or not the House, the Senate, and the president can all agree and make a change to that sunset. So that's a business decision to be made. And a lot of people think that might be pretty tough based on today's politics. So we're really in another risky situation, and we're in a state of flux here potentially, is that there's two bills that were introduced, one in the Senate and one in the House, and to change the estate tax, right? Where the exemption would be $3.5 million with a rate of 55%. And as an aside, the current rate at the federal level is 40%. So that they're talking about lowering the exemption down to $3.5 million with a 55% estate tax. And then once the state reaches around 93 million, it goes to 65%. And then for estates above $1 billion, there's a 10% surcharge. So there is change in the air as the estate tax is being talked about in Congress, and we'll see where that ends up. But I want to make a point of it, though. Absent presidential, Senate, and House agreement, that the current, sunsetting on December 31st of 2025 is the law. So in the current environment, globally, what we're, wanting clients and folks to think about is that we really are in an all-time high, situation with the $13,610,000 exemption, and we're in a use it or lose it situation. Because the odds are, at least in my personal professional opinion, that there's a good chance that exemption is going to be going down, either sunsetting or through some type of change. And the idea would be, let's take the safe route and use the exemption while we can and not lose it. Another thought that we have is it all depends on people's views and their business decisions going into the future. A lot of people, clients, are going to want to delay. right? And they're going to want to take their chances depending on who wins that election, right? And the idea is one thing to consider for all the planners and professionals on this call is that the planning that Bob and Ed are going to be talking about in detail, it takes time to implement. And if you're going to do it properly and do it the right way, there's certain timing and spacings in time that we want to consider and have the ability to implement or to use that time. So the clients that get on the bandwagon and get planning quicker are going to get higher quality work from their professionals, and it's going to be done better because of just the pure timing. So, and there's going to be, we believe that there's a lot of estate planning attorneys, valuation experts, and accountants that are simply going to be overwhelmed by the work that we're going to be talking about today. And there's going to be there's going to be a professional bandwidth epidemic, coming in around possibly July or maybe into the fall of next year. So the people who get on it quicker and get ahead of the curve, I think are going to end up with a better result long-term for their families. So please consider that. So today we'll be talking mainly about, spousal lifetime access trust planning. And we're going to be talking about the basics of that and also including installment sales. We're going to be talking about avoiding risks in funding and administration of implementing a SLAT plan, including the reciprocal trust doctrine, which we'll get into some detail later. Importantly, and from our perspective, it's quite enjoyable, is that we're going to teach you guys a little bit of how to improve an ordinary SLAT. At Kelleher and Howland, we work really hard to come up with unique ideas that work for our clients that help our clients maybe more than the average bear. So we're going to be talking about upstream optimal basis increase planning, which is seizing basis opportunity for irrevocable trust to achieve basis increases at an older beneficiary's death or at subsequent generations. Okay, and that also can apply to people that not necessarily are older, but maybe people that are maybe not as healthy or maybe sick. We're going to be talking about keeping the income tax burn advantage of grantor trust status after death of the settlor with beneficiary income accumulation trust provisions that are unique to KH. And it's going to allow the surviving spouse and ultimately descendants harness the tax burn advantage, which is extremely important mathematically in SLAT planning. We're going to talk about swap and SURF planning. And this is different ways to get the estate tax exclusion while also preserving step-up basis. It gives you the ability to get the estate tax advantages and also achieve a capital gain step-up, which we'll talk about later. We'll talk about ILET rescue provisions. We'll talk about irrevocable grantor trusts, designed to be completed outside the taxable estate. We'll talk about setting up by one spouse for the primary benefit of another spouse, the SLAT plan, and that's usually what it entails. We'll talk about multi-generational transfers of wealth throughout the generations, because a lot of the SLAT plannings many SLAT plans are designed to be dynasty trusts that can keep wealth outside the taxable state at the federal and state level for multiple generations. We'll talk about the creditor protection provided to beneficiaries. We'll talk about, like I talked about earlier, is that utilizing the $13,610,000 current federal exemption, right, and leveraging that now through using valuation discount planning implemented within the installment sale process. And we can also talk about using the $18,000 current annual exclusion amount with crummy powers and how we design that in funding trusts and irrevocable trust and SLATs. We'll talk about how we can protect with SLAT planning the future appreciation of assets from being taxable in many times a multi-generational estate tax-free environment. And we'll talk about how how swaps and substitution of assets can be used to both achieve the estate tax savings with spousal lifetime access trust planning, and also ways of achieving the step up in basis of those assets that are in a SLAT. With that, prelude and introduction, I'm going to turn it over to Bob so he can talk a little bit more about the planning.
Thanks, Andy. Yeah, so, the slide here, installment sale to grantor trust, but just kind of reaffirming some of the general concepts here. if I have a SLAT, I'm creating a SLAT. Let's say I'm working on a family. It's Joe and Mary Smith, a married couple. And let's say Joe is creating the SLAT. Joe is going to create an irrevocable trust. It's irrevocable. It's generally a grantor trust back to Joe, meaning that Joe is still the taxpayer. So generally speaking, the tax ID number for the trust is Joe's social security number. The SLAT is generally not its own separate taxpayer, subject to the condensed income tax rates, forced upon many irrevocable trusts. And in many cases, in setting that trust up, Joe, as the creator and grantor of the trust, cannot be the trustee of the trust, can't be the manager of it, and is not a beneficiary of the trust, generally speaking. However, spouse can be a trustee of the trust, the primary beneficiary, with kids or other descendants as backup beneficiaries. And by Joe not being the trustee, not being a beneficiary, it's irrevocable. Any assets that Joe places in that trust is a completed gift. Meaning, if I want to use up my $13.61 million gift and estate exemption before it sunsets and potentially gets cut in half or lower than that, I can gift that amount of value into that SLAT, and now I've locked in that gift threshold. So at the end of next year, if it sunsets and the threshold comes down to say 7 million, if I've already gifted to 13.6, I've locked that in. And generally, that it won't be subject to a clawback where the federal government says, well, you've gifted 13.6, we've lowered it to 7. What about that difference? Well, the difference here is the win. We'll have been able to push more value outside of the taxable estate before the rules change. In many instances, we want to, go beyond just making a straight gift into a SLAT or into an irrevocable grantor trust. We want to incorporate other concepts. And I think a lot of you on the call here have heard of these things. Can I do an installment sale with the use of a promissory note? What about valuation discounting? What are these AFR rates? What if I've already used up most of my gift exemption? How can I move more assets outside of my estate if I only have a little bit of threshold left? Maybe I've already gifted $12 million away during my life, and I only have 1.6 million of exemption left. If I have that much left and I really have an intent to move more than that outside of my taxable estate into a SLAT, how can I do that? So this installment sale to grantor trust is a real common example of an advanced planning technique, utilizing not just SLAT planning, but promissory note, entity and valuation discount planning, and other topics, which we'll walk through here. So I'll go through this slide and the next relatively quickly because we have a flow chart and an example that I think makes this easier to understand. But generally speaking, again, Joe Smith, he creates an irrevocable trust, and a key portion is it's a grantor trust, meaning it's still taxable back to Joe for income tax purposes. And then I'm going to take some assets and generally gift a little bit of value into that trust as a gift, but I'm going to take a big chunk of assets, an LLC that I've created that owns a bunch of assets, a business interest, real estate holdings, marketable securities. I'm going to identify a block of assets, and I'm going to sell that block into the SLAT in exchange for a promissory note. Generally speaking, if I take $1 million of assets and sell it into the SLAT in exchange for $1 million promissory note payable by that SLAT back to me, I haven't yet burned up any of my exemption because it's a sale. And because it's a grantor trust, meaning Joe is the same taxpayer as that trust, that sale is not an income tax event. So there's no gain or loss or income tax consequence of moving these assets around. That promissory note now that the SLAT owes back to Joe has to charge a certain amount of interest, which is generally referred to as the AFR, or applicable federal rate. Those rates change on a monthly basis. There are short-term, mid-term, and long-term rates. The current, noted here on the slide, the current September 2024 midterm rate is 4.02%. Although those rates change on a monthly basis, once you lock in the transaction, meaning if we were closing on one of these planning methods today, we were using the midterm rate, we could lock in that 4.02% going forward. We could refinance and come up with some other strategies if it was beneficial to change that. But even though that rate changes on a monthly basis, it's not a variable rate. It can be locked in. And the basic idea being, if I sell assets into that trust, if I take that $1 million block of assets, I sell it in a trust in exchange for $1 million note, that trust has to pay me back that 4.02% interest. But if the assets now inside that SLAT, inside that trust, appreciate at a rate greater than that 4% interest rate, all of that appreciation is now happening in an environment that's outside of my taxable estate, and I haven't burned any exemption yet because it was a promissory note back to me. So who can benefit the most here? Somebody that has assets, I think that they will appreciate over time, and with some liquidity and cash flow component to be able to absorb the note of the annual interest payments coming back. But Amy, if you want to go to the next slide. It's essentially a freeze technique. I'm taking $1 million chunk of assets today, putting it into the SLAT. SLAT owes me $1 million. Now that I've frozen that $1 million block of assets, the valuation in time, essentially. All the growth on that is now outside of the taxable estate. So if I pass away and I'm doing the math, am I over or under the $13.61 million threshold, or if it lowers, or a state level estate tax, and you mentioned the Illinois $4 million exemption, that appreciation is all away from the calculation. There are some risks with this, nothing that hasn't been chewed on before. And as long as it's done correctly in the right time frames, documented accordingly, disclosed to the IRS and certain gift tax returns, we don't feel like the risks are anything that we can't overcome. But there is some uncertainty upon Joe's death in my example, if there's an outstanding promissory note of the tax consequences of that. And if the growth rate on these assets is less than the interest coming back to me, I may not get the appreciation outside of the estate. But the next slide here, I think, does a good job of illustrating an example. And hang in there with us on this one. There's a lot of moving parts to this, but this is, again, a pretty common planning technique. So and I'll just walk through this as an example. We sit down with Joe and Mary Smith. It's a high net worth family. They know that the rules are about to change. They've been being told, hey, you got to look at this. You got a nice window of opportunity to do some planning, between now and the end of 2025. Don't wait till November or December of 2025, because it'll be really tough getting the full attention and the proper time frame to get this planning done. So let's sit down and start talking about some ideas. And this is a good illustration of an installment sale to a SLAT or an irrevocable grantor trust that incorporates promissory notes and valuation discount techniques and other items. So here's how it would work. In this particular case, the target asset, the block of assets we're going to say is a $5 million chunk of marketable securities, traded equities. So nothing overly complex. Currently, Joe and Mary have an investment account with their wealth advisor with these assets invested. And instead of just taking those assets, the $5 million of securities, and moving them directly into the SLAT, the irrevocable trust, the first thing we're going to do is set up an LLC. We call it the Smith Family LLC, or Smith Investments LLC. Joe and Mary would be the initial owners, and Joe would be the manager of that LLC. And we would take that $5 million block of marketable securities, open up a new taxable brokerage account inside the LLC, and drop it right in there. We don't have to liquidate the assets. We just drop them in kind into the LLC. Joe is still the manager of the LLC, so he controls the day-to-day management of that account with the wealth advisor. So whatever the traditional wealth planning objectives, investment strategies, otherwise, those don't have to change. But now on the balance sheet, Joe and Mary have their ownership interests in this LLC. And we generally split that ownership between voting units, or the control units, and non-voting units, or non-controlling units. In this particular example, We have it where Joe has 98% of the LLC and Mary 2%. But we've isolated the voting and control to 2% with Joe and 2% with Mary. So although that's only 4% of the overall equity, it's 100% of the control. We then have this 96% or 96 non-voting units of the LLC, and that's now the target. Those non-voting units, that's now the asset that we're going to use and sell into the SLAT, into the irrevocable trust. The green box here in this chart, that would be the SLAT. That would be the irrevocable trust that Joe's setting up, of which Mary is the trustee and primary beneficiary and their kids as secondary beneficiaries. But it's a grantor trust, so it's the income tax associated with that SLAT is taxed back to Joe's personal income tax return and the Social Security number. And instead of Joe just taking the now 96% of the LLC and gifting it into the irrevocable trust, we're going to sell it. Generally, Joe would make a gift of some seed money, some cash into the irrevocable trust. We want to put some cash into that trust to essentially make it a viable buyer. There isn't a rule of thumb on how to do that or exact amounts, but rule of thumb is Joe would make a gift and burn up some of his $13.61 million threshold of about 10% of the value of the asset we're going to sell, just as a rule of thumb. But the first thing we're going to do here is say, okay, Joe's essentially going to sell his LLC interest into this SLAT. The LLC has, we know what the LLC has. It's $5 million of marketable securities. We know what it's worth. But we're not valuing just the marketable securities anymore. We're valuing Joe's ownership interest as LLC interests. So when we value what the worth is for a sale or a gift transaction, we'll go get a valuation of the LLC in a discount study. And that's integral to this. Although I know there's $5 million of value in this LLC, if I go value it for gift and estate tax purposes, I generally can take a discount, a valuation discount. And that discount percentage may range depending on exactly what the underlying holdings are, what the LLC documents say. But in most cases, we generally see about a 30% discount. So when I'm valuing this and I'm determining the sales price to sell it into the SLAT, even though I know the LLC has $5 million worth of assets, if I take a 30% discount, the sale is roughly $3.5 million. So if I sell the assets into that SLAT owes Joe back $3.5 million promissory note. Well, what does that mean? On day one, I've only used a minimal amount of my gift exemption to put a little bit of that seed money in, maybe about 10% of the sale amount. So 10% of 3.5 million or roughly 350,000. But then I've moved $5 million in actual value, using round numbers here, into the SLAT. But the SLAT only owes Joe back a $3.5 million promissory note due to the valuation discount. So on day one of this, $1.5 million of value of equity is in that SLAT. $1.5 million of value is moved into that SLAT and now outside of the taxable estate immediately, plus all its future growth, minus the interest payments back on the note. The way that we generally structure this, and there's no right or wrong approach here, is that'd be a 9-year promissory note from that SLAT back to Joe. A 9-year interest-only balloon note, to be more specifically. So over the course of that 9 years, there's an interest payment. At the end of 9 years, you'd look at paying that note off, extending it, or figuring something out at that point in time. Another reason why this strategy is common as opposed to a straight gift into the trust is a lot of clients say to themselves, well, I know I need to do some estate planning. I realize if I make a gift into a SLAT that my spouse is still the primary beneficiary of it. So between my spouse and I haven't given up access to the assets, because with my spouse as the primary beneficiary, my wife could make a distribution and get these assets out of this structure if needed. But I just don't like the idea of truly giving it away. What if I really don't need to make this gift? What if the rules don't change? Well, if I sell it into the SLAT, yeah, I'd push some value back, but I still have a $3.5 million promissory note coming back to Joe here, which is a nice string to pull and take some of that value back. The other benefit is it's almost a little bit of a wait and see strategy. If I execute this planning now here in 2024, and then depending on the election results, what's happening next year, and we get closer to the end of 2025, and we realize, uh-oh, they are lowering the exemption by more than we thought, or for sure lowering it. I do want to make sure I lock in a bigger gift before that happens. If this is all already in place, I can merely gift that promissory note back to that SLAT. I can rely on this structure. I'm not running around in December of 2025 creating all this. I can utilize this and just get rid of that note, and that would be the gift. So another advantage of this, and some math here to look at. Assuming a 30% discount, like I said, assuming the current midterm September 2024 AFR rate of 4%, and also assuming that $5 million of marketable securities in the example inside the LLC are growing at 5% year over year, which I think is a fairly conservative benchmark. Then after 9 years, so I've done this planning, I funded the LLC, I sold the LLC to this SLAT. SLAT owes me that promissory note. Let's assume the assets have been growing at 5% each year for 9 years. The note's been paid off now. There's at a 5% growth rate, there's about $3 million of value still in this SLAT structure. And at a 40% federal estate tax rate, it's over $1 million in savings. If you're an Illinois resident, and we have to deal with the Illinois estate tax as well, it's almost $1.5 million in savings. If you assume an 8% rate of return, the savings just go up. You got over 2 million plus federally, and over 2.5 million if you combine Illinois and federal. And that's only after 9 years. If I do this planning now with my spouse and we put this together, knock on wood, I live a little longer than 9 years. Let's say I live another 30 years. Well, this math gets really compelling quickly as far as the overall savings, for a family. And I realize this is a mouthful, especially if you haven't done one of these plannings before. And that's why, we like, for a couple of reasons. One, from a tax perspective, we don't want to create all of these documents, fund the LLC, do the sale and the gift all in the same day. We'd like to spread this out for various reasons. But also, too, from a client perspective, by taking this in stages and having a couple, meetings to explain this, go through it, chart it out, run some examples, just more digestible. So it's just not one, big bite of the meal at once. So it just generally makes it easier for not just the professionals and the planning team, but the clients as well.
And Bob, a common question that we get from people and clients is does the same kind of division between voting and non-voting work for S corporation owners? Do you want to kind of explain how that works?
Sure. So yeah, in this example here, we're merely going with an LLC, with marketable securities. But in a lot of instances, the big asset is maybe the family's business, and a lot of times we see them taxed as S corps. And we still want to isolate the control so that if I'm moving some business interest into a trust for family members, spouse, kids, or otherwise, I still want to isolate that control so I'm not giving that away. Generally, S corporations could only have one class of stock. That's part of the restrictions of the S corp structure. But splitting the stock between voting in control and non-voting isn't considered a second class that would violate the S corporation rules. So although not in this example here, an S corporation is a great target asset for something like this.
Hey, Bob, a lot of clients also ask if they implement this type of planning, as you described. Can you describe to the audience as far as what income tax reporting is included or involved in this planning as suggested?
Sure. So once this is all set up, the LLC itself would generally be taxed as a partnership and would have an annual income tax filing requirement, meaning that every year there would be an additional income tax return to file, generally a Form 1065 partnership income tax return. But the income associated with that it's a flow through entity, would be pushed up to the partners. So in other words, in this example here, with that $5 million marketable security account would issue a 1099 with maybe some interest income, dividends, capital gains activity. It would be allocated via a K1 on the partnership return to Joe and Mary respectively. Those their trusts, both their revocable trust and the SLAT. But because the SLAT is taxable back to Joe, all that income still flows right up to their personal income tax return, which is a nice benefit of this. It's actually a little bit of a hidden gift. Because if you think about it, if this SLAT owns 96+% of the LLC, and there's income, which I would think there would be income inside this LLC every year based upon the trading activity in this example, or if it's the S Corp business example, the income generated by the company. If it's all ultimately flowing back up to Joe and Mary's personal income tax return, they can pay the income tax every year with monies from their personal balance sheet that's not associated with the SLAT that's outside of their estate. So we don't have to take value out of this structure to carry the income tax cost of it. So another efficiency overall with the planning. But with that, and I see we have a couple of questions. I'm going to hit that at the end. I'm going to turn it over to Ed to talk about certain situations and then some other enhancements on a traditional SLAT structure.
Thanks, Bob. Well, yeah, a couple of other situations that we get questions about, and that kind of surprise people to learn about. When we get people saying, well, can you put personal use assets like my vacation home down in Florida or Arizona or somewhere, can we put that into a SLAT? And generally, the rule is that probably the optimal assets to put into a SLAT if you're in a potentially taxable estate situation would be the assets that you expect to grow the most. But maybe for some people in certain locales, maybe real estate might be in that category. But you can actually put a vacation home into a SLAT, and the settlor can still use it. That sounds like it's too cutting edge and too good to be true, but believe it or not, there's a court case on it and a revenue ruling where the IRS acquiesced under the theory that if the donee spouse has the right to use the property, and that's drafted correctly in the trust instrument, the donee spouse can let the grantor spouse use the property just like any other guest. If you own a property, you can have anybody else you want use the vacation home, right? And so that doesn't necessarily mean there's a retained interest by the settlor or cause any estate inclusion problems. So believe it or not, that's actually pretty safe. There's a court case that the IRS agreed to file on that particular point. Loans to the settlor, as long as they're properly documented and you really are paying interest and things like that, kind of like the structure that Bob had went through just a few minutes ago, those are actually pretty safe ways to access the funds in the SLAT as well. People always ask us, can a spouse be the trustee? And believe it or not, there's a trust, your spouse can be a trustee as well, co-trustee, or even the sole trustee. It's a little bit of risk, sloppy administration. Like if the trustee kind of just ignores all the formalities, they start paying all their personal bills out of the trust and things like that, and kind of ignoring that the trust is there. That is a little bit of a risk. So if you do have individual family members, they probably should make sure to seek legal and tax counsel in the administration of the trust. If you're not going to use a professional trustee like a bank or, trust company or such, if you wanted to be super safe, or if you had, the trustee says, well, I just don't like dealing with financial things. Well, consider a professional trustee, and that's going to be a little bit safer, and that's going to not have any problems at all. If the spouse is the trustee, though, you can't have unlimited distribution standards. We would put in because the IRS would say, well, look, if you are the trustee and you can distribute it to yourself in your own discretion, that's like it's your own money. That's going to be in your estate. Under 2041 of the code is a general power of appointment. So what you do is the trust has what they call a distribution standard subject to health, education, maintenance, support, what they call an ascertainable standard that the court could actually come up with a dollar amount for based on your standard of living prior to the establishment of the trust. So we always include provisions like this at K&H, but we also want to have a backup provision too. What if you really did, for some reason, need more than what might be deemed to be for support, or maybe the kids don't agree with what the level of support is, or whatever reason? You can also have an independent trustee be appointed later if the trust permits, and it should. And that independent trustee can have broader standards that go to the best interests, or for whatever reason the trustee determines for support of the surviving spouse. So that gives a lot of flexibility, even, to contribute, distribute the entire trust out, even to a completely new trust by decanting, or outright to the spouse altogether if we had a huge change in tax law or something like that. So there's a lot of flexibility we can build in. Why don't we go to the next slide, bring up a couple of other things that you might think are risky, but really aren't. We mentioned before, Andy said, well, the settlor can't be a beneficiary to make sure that it's outside of everybody's estate and to get that tax savings. But the trust can allow the trustee to pay or reimburse the settlor for the income tax resulting from trust income being attributed to the settlor. Now, usually for people that have taxable estates, as Bob said, we call this the tax burn. This is actually a good thing. If you're paying the tax for your trust that's outside of your estate, the the trust grows tax free. You're just kind of turbocharged, right? So that's why most of these trusts that we set up are not non-grantor trusts paying their own tax bill. We set them up on purpose to be grantor trusts. Some people use the term irrevocable defective grantor trust. I hate that term. It's not defective at all. That's the way it should be done 99% of the time. So we put these kind of clauses in that cause the grantor to be taxed on it for income tax purposes. But when 10 years go by, maybe the grantor's got some tax flow issues. Maybe they're not as wealthy as they were before. Whatever reason, they don't want to pay the tax bill anymore, or at least they want to be reimbursed for it. Well, we can build in a clause into the trust that says, trustee, you've got the discretion to pay the grantor's income tax bills that they've had due to this grantor trust status. You might think, well, that sounds like too good to be true that you have that in. But no, the IRS has actually acquiesced and issued a revenue ruling confirming that this kind of clause doesn't cause a gift or estate inclusion. As long as the trustee has a discretionary power to do it, it's not mandated. And as long as it's not subject to any side agreement whereby the trustee promises to the grantor to reimburse them if they ever ask for it, no, it has to really be at the trustee's discretion. And you also have to have favorable state law. Now, I've got a 50-state chart if you're in a different state other than Illinois, and I can look this up for you. But Illinois, within the citation here, is very favorable. Most states are pretty favorable on this. There's a handful that aren't. But most of them, in most states, it's going to be allowed, and it's not going to cause any creditor problems. In other words, the creditor can't say, aha, that's a self-settled trust, and that means I can get at the money that you put into this because the trustee can distribute money to you. No, no, no. Illinois law says this is protected, and it's not a self-settled trust just because you can reimburse income taxes. You got to be careful to have this in from the outset. The IRS just issued a ruling just a few months ago where these parties tried to add the reimbursement power later, and it caused all kinds of problems. If you don't have this provision in there to start with, there was a case out of Ohio where the father set up a trust for his kids, and it was wildly successful. It did great. It got all kinds of money outside of his state. All of a sudden, he woke up one day and there's a $5 million tax bill he doesn't want to pay. I mean, this was a pretty wealthy family. And so he said to this son, the trustee, hey, can you go ahead and reimburse me for the income tax? And he said, no, I don't think I can. I'm hamstrung because there's no provision in the trust to allow this. His dad went to court, and the court said, no, you're not a beneficiary. It's not in the trust. So sorry, we're going to toss your case out. So just a lesson learned, you got to have this kind of provision in that's consistent with Revenue Ruling 2004-64 in on the outset, and that'll save you a lot of pain down the road when the settlor doesn't want to pay the tax bill anymore. So let's go to a couple of other things that we want to add on the next slide. This is something that, say, the vast majority of practitioners overlook. And it requires a little bit of a mindset shift. You have to look at the applicable exclusion amount of 13.6 million, or whether it goes down to 7 million, or whatever the heck it is at any given time, as a basis increasing coupon. It's a coupon that everybody gets to step up the basis and assets in your estate up to that amount without any estate tax applicable. Look at it that way. And then when you realize, hey, wait a minute, there's a lot of people here who could step up the basis of their assets, more assets, if they just had more assets. And what this means is most, even wealth people, have older relatives. Even the 65-year-old that comes into your office, 50% of your clients have one mother or father-in-law or a parent-in-law, or maybe it's an aunt or uncle that they're close to that's still living and maybe in their 80s or 90s. You can make them a beneficiary of the SLAT too. Now, why would you want to do that? People usually think, oh, I'm only going to set these trusts up for people who are younger than me that really need it. Why would I set up a trust for somebody that's older than me? Well, first of all, people already kind of help out older relatives. One-third of the clients that we work with help out their older relatives at some point in their life. It's very common. I helped out with my dad with some different things, and then most of you on this call have clients that have helped out older relatives financially at some point, or they may in the future. If you look at what a nursing home costs, it's not too hard to imagine that. Well, what if we give them a certain power over the trust that causes estate inclusion? When the older relative dies, the assets would be included in their estate. And what happens if they don't have a $13.6 million estate? Well, they get estate inclusion, which causes a step up in basis under 1014 of the code, but they don't have an estate. It's the best of things. I get an estate if you get estate inclusion, but don't pay estate tax. So what we can do here is I can add my mother-in-law, my father-in-law, or anybody that doesn't have a $15 million estate or $13.6 million estate. And I can add them as a beneficiary, grant them certain power of the trust called a general power of appointment. And at their death, not at my death or my wife's death, at their death, there's a step up in basis. And we can put a cap on that to the amount that would cause any estate tax. If they live in a state like Illinois with a separate state estate tax, we may limit that to the $4 million or whatever the exemption Illinois applies at the time. If they move down to Florida, Florida doesn't have an estate tax. The exemption level is going to be 13.61 million or whatever the federal level is at the time. At first, this kind of scares people. They hear the term general power of appointment. Doesn't this allow you to appoint to your creditors or appoint to your state? What happens if my dad or mom, they appoint to my sister or my brother or something like that? Well, there's ways to make this power capped and circumscribed in a way that it really can't be exercised without consent of several other different parties that the settlor, your client's going to choose. So the settlor can say, you know what, I'm going to give this power to my dad who can appoint to his estate. But you know what, he can only appoint to that with my friend Andy and Bob's consent. I'm pretty trustworthy that Andy and Bob's not going to allow my dad to appoint to his creditors or something like that. So I'm pretty safe in having that kind of power. But the important thing is that kind of power still causes estate tax inclusion, still causes the step up in basis. And believe it or not, what we can do, this works even for highly leveraged property. I mean, we could even put a zero under this example, instead of 6 billion, 60 million, and it probably work just as well, if not more so. But let's say Joe and Mary Smith, kind of like the example that Bob had put up on the screen, they set up this $6 million of property into a SLAT with the $3 million of loans and $1 million of basis. It's worth $3 million. How they got it in there, whether it's gift or sale, doesn't really matter. There's $3 million of property in there, but the $6 million gross with $3 million of loans. If they include that power that I mentioned in a parent or mother-in-law's estate or something like that, it's included in their estate. What is the basis at their death? The basis is the fair market value, $3 million, plus the debt associated, $3 million. The basis steps up from 1 million to 6 million. And by the way, I've seen situations, we've been involved in situations where the numbers are much, much higher. What that means is a step up in basis means is less capital gains when you sell the property later, or if it's expensable or depreciable property, maybe it's a business, maybe it's real estate, maybe it's a farm, the savings is more immediate and even more start because you got that depreciation schedule starting even sooner, and the savings start now, not when you later sell the property. So the capital gain savings from an upstream SLAT is tremendous. And by the way, if you're not married, you can set up an irrevocable grantor trust for a single person with the same kind of upstream planning involved. The other question we get is, can I have more than one older beneficiary? Yes, there's no limit to this. Can I use a stranger's life? Probably no. When you get a little bit too cute, the IRS is probably not going to let us do that. But if it's a bona fide relative or somebody that you have a relationship with, it can work. So definitely consider upstream planning. But we put a lot of other clauses in the trust. Let's move on, Amy, to the next one.
Hey Ed,
You
I have
know,
I have a question for you. So going back to the upstream
sure.
planning, I was trying to interrupt you, but then so Joe can set up an irrevocable trust, like using the Smith example. He can set up the irrevocable trust for Mary, right? And let's say, for example, Joe's dad is 90 years old and lives in Florida, and his only activity is maybe to watch Wheel of Fortune at 5 o'clock. And let's just say it doesn't have a large estate. Let's just say it's $1 million. So this would allow Joe to set up the trust for Mary and then and Joe and Mary's kids, that SLAT, and have the assets the owned by the SLAT, but intentionally include Joe's dad in Florida as a beneficiary of the trust, and granting Joe's dad the power, the general power of appointment you're talking about, so that when Joe's dad passes away, we don't cause any estate tax issues for Joe's dad, but we include the assets inside the SLAT that those assets stay there only for Mary and the kids. They don't go to the dad. They stay there only for
Right.
Mary and the kids, but they, in a sense, use dad's estate tax exemption, not causing any problems for the dad, to step up the value of the assets inside of that trust, right? And so if Mary turned around the next day, to sell those trusts, after let's say Joe's dad died, and the day after Mary, sells those assets to a third party, would there be any capital gains on that?
No, no. And, the assets would be stepped up in basis to the date of death. And that's the important thing. And the other thing I kind of glossed over a little bit. I mean, obviously, this can be kind of complex planning, Andy, but the important thing to realize is that we typically have a taker in default. In other words, if the power of appointment is not exercised, Joe's dad doesn't exercise it, maybe he doesn't care about it. He gets a copy of the trust, he ignores it, he doesn't even know he's got a power. But the important thing is, even if it's not exercised and it just stays in trust for the spouse and kids, the mere fact that Joe had that power at his death, the IRS says you got to include that in your estate. And the Congress put it in this way to trap people and to get people to pay more estate tax.
Mm-hmm.
What they don't realize is 99.9% of the people don't have estates over $13.6 million. So causing inclusion with a power like this is a win for most situations. So as long as Joe's dad doesn't have over $13.6 million, having him as a beneficiary with this kind of power can yield big benefits to the spouse and the family on any appreciated asset.
And just for the audience's edification, Ed has written extensively on upstream planning, and this is Ed's original idea, and it's a fantastic win for our clients. And what we love about it is that for Joe and Mary, a lot of the planning is for estate planning and helping out their children and the generations to come, which is really neat about the upstream planning and this capital gains planning. It actually helps out Mary and Joe now. So it actually helps our clients, the people that are sitting across the table from us at meetings, and not just people in the future, their kids. So a lot of clients really love this, and this is a fantastic idea, a concept that's been out there for a while, but the original person that came up with this idea is our friend Ed Morrow. And we like to give credit where credit is due, because out there in the world, a lot of people don't do that, but we do. So I think it's one of our it's a great way to save our clients a lot of money. So sorry, Ed, I cut you off there, but I just want to make sure people are aware of your prowess.
Oh yeah, and we've got plenty of long white papers for the tax nerds out there who want to learn more about this. The next one, though, I'm really excited about too, Andy, because we've heard for decades, ever since I've been in practice, about the great benefits of grantor trust. You got to make these trusts grantor trusts. You got to be grantor trust. It's malpractice if you don't have this trust be a grantor trust. Well, the way people draft bypass trust and Q-tip trust and idiots and SLATs is that They draft them as grantor trust, but then when the settlor dies, it becomes a non-grantor trust. What's the problem with non-grantor trust? They pay their own tax bill, and it's a highly compressed tax rate where you get the top tax rate at $12,000, $13,000, $14,000. You hit the 3.8% surtax, not at 250,000. You hit it at $14,000. The top 20% capital gains tax rate, you don't hit it 600,000 or 500,000. You hit it at 14,000. The highly compressed tax rates of the trust are devastating for the middle class because you've got a widow who might be in the 22% bracket. If she's getting this in trust, it's a non-grantor trust, it's 40.8%. And that doesn't even count Illinois. So this is a disaster that a lot of people don't really appreciate the fact that grantor trust, when the grantor dies, become non-grantor trusts. But there's a way to get around it. There's a special code section, 678 of the code, that says, hey, there's going to be some circumstances, even if the grantor is dead, that in certain circumstances, we're going to tax the income of the trust to the beneficiary. If they have the power to withdraw all the corpus, like a revocable trust, it's taxed to them. But we don't want to draft trusts like that because then it's all in their estate and there's no asset protection, no creditor protection, no divorce protection. But what people have really overlooked for years is under 678 of the code, you can give the power to the surviving spouse or whoever, the children or whoever the beneficiaries are. You can give them the power to withdraw only the income. And guess what? It's taxed to them on 1040. They don't have to even do a 1041 tax return. It's taxed to them on their 1040, but it's not included in their estate other than maybe income that they can withdraw at their death. The beauty of that is we're avoiding the compressed tax brackets. We're using the tax burn of grantor trust because guess what? This GST exempt trust that we've got going on, do we want it to pay its own tax bill or would we rather have the beneficiaries pay the tax bill? It's the same thinking along the lines of grantor trust that we want to set up. We don't want the trust to stop being a grantor trust just because the grantor is dead. We want it to continue being a grantor trust as to the surviving spouse, as to the children, and then to the next generation, as to the grandchildren. The only time I don't necessarily want to give a withdrawal power over the income is in special needs trust situations, or if I've got a substance abusing beneficiary or something like that, I'm not going to give them with withdrawal power. But in 90% of the situations that we deal with at KH, Andy, a lot of these people that are setting up trusts for their kids are in their 40s and 50s. They're responsible adults. The parents are setting these up in trust for the kids, for the divorce protection, for the creditor protection, for the estate tax sheltering, and avoiding Illinois tax at every generation. The benefit of the BDOT planning, or what we call BIAT planning, which is K&H's Beneficiary Income Accumulation Trust clauses, is we're shifting the income tax burden while keeping the flexible protections of a trust. So this is really unique. I get really excited about it. I could speak for another hour about it, Annie, of course, as you know. But the key thing is adding certain clauses to this trust enable the beneficiary to pay the tax bill, but they don't have to take it all out. They can take any percentage that they want. And the advantage to that is we're keeping the money into the trust, letting it grow tax-free, protected from creditors, divorce, et cetera, getting the income tax bracket benefits of the individual, whether they're married, filing jointly, or single. It's going to be 10 times better than the tax brackets of a non-grantor trust. So BIAT planning, or what sometimes we refer to as beneficiary deemed owner trust, you'll see that referred to generically. Ours is just kind of a version of the BIAT that's got some really flexible provisions in it. Time, let's go to the next.
Yeah, and just for the purposes of the audience. So I know we're talking mainly about SLATs today, but the BIAT planning, the Beneficiary Income Accumulation Trust planning, which is going to, over the course of time, save the family a lot of estate taxes and provide them a lot of extra income tax deductions and make things a lot easier for reporting. But the idea with the beneficiary income trust accumulation is that it also applies to family trusts and revocable living trusts. So for the folks out there, although we're talking about SLAT planning, right, the BIAT provision should be placed into most family trusts and marital trusts and normal revocable trust, AB trust planning, and not to consider doing BIAT planning in modern drafting is, in my opinion, I'll just speak for myself, is quite an error. So it's something to look at to help out clients to achieve a better estate tax result for their family and also achieve much better income tax results. So Ed in the past has a wonderful treatise on this topic. And also on KH, you'll on our web on our YouTube video series, we also have a video explaining a beneficiary income accumulation trust planning, otherwise known as BIAT, in additional detail with some videos that may make it easier for the audience to understand, because we're covering a lot of territory here today.
Yeah, thanks, Andy. That brings us to another topic that I think that, and these are topics that I think kind of separate the ordinary wealth advisor and the more experienced and professional and more competent wealth advisors and attorneys. We don't want to just set up this SLAT or an IDGIT, set it and forget it. You've got to kind of monitor this as years go by. And one of the unique things that your grantor trust allows is what we call a swap or a substitution power. And why this is really important is to mitigate the downside of SLATs and IDGITs. Is there a downside? Well, yeah, one of the drawbacks to getting more funds out of my estate is those assets don't get a step up in basis when settlor dies. That's why you don't want to gift all your appreciated assets right before death, because then you just lose a step up in basis. That'd be a horrible malpractice planning to do. Over time, you'd want to gift assets and get the appreciation out of your estate. But ideally, what you'd love to have happen is when you get that cancer diagnosis, you're in the hospital, you've only got so many months to live or whatever, you take those assets back, the low basis assets, and you put cash into the trust of equivalent value. The IRS allows us to do this. There's a revenue ruling specifically on this that allows this without causing a taxable event. It's a grantor trust. This is a non-income taxable transaction. And so we want to pay attention to somebody's longevity and longevity risk. And ideally, what we want to do is, take back the low basis assets so that when somebody dies with the low basis assets, they get a step up in basis. But at least in the meantime, before we did that, we got all that growth from that high growth appreciated assets out of the estate. Now, the problem that we have, though, Andy, is I've seen a lot of $100+ million estates where we've been really successful in getting a lot of the money out into the irrevocable grantor trust. Do they have $50 million in these irrevocable trusts? Do they have $50 million of cash to swap? People didn't get rich by investing in cash and cash equivalents, right? They're just sitting on a bunch of short-term bonds. They're invested in real estate and businesses and private equity and stocks and the financial advisors on this account know that you don't want to put too much in cash typically, right? So the problem is people don't have the cash to just swap, and you really don't want to just use a promissory note back. The IRS might see that's a little too squishy, too cute. And if the note doesn't qualify as debt, you don't get a deduction under 2053, the code for debt in the estate. That would be a disaster. So what you'd ideally like to have is a line of credit established before. This is easy if you've got a stock account, you got a margin account, maybe, but it's a little bit more tricky if you've got more liquid collateral. But the key thing is get this kind of set up before somebody turns ill, because you can't just get a $50 million loan approved like that, right? This takes a lot of time to get set up. You have to get all the parties to kind of approve everything, and you've got to have control agreements, and you've got to have the trust and the power of appointment or the power of attorney examined. In short, it can be done, but it can yield huge, huge amounts of savings for capital gains tax. If you had $50 million of assets that are, in really successful grantor trusts and SLATs that now have a basis of like $10 million, the capital gains difference is $40 million. Okay, and the step up in basis, if we just do a quick math of 25% of $40 million appreciation, it's $10 million of savings. If you can get the $50 million of appreciated assets out of the IDGIT or the SLAT back into the settlor's estate right before death, and then be able to get cash into the trust, you just save the family $10 million. Pretty low risk as well. So, this is planning that we kind of have to work with an attorney and the wealth management team and the bank or other lender ahead of time to get kind of set up so that it's ready to go, because you can't just do this overnight, right? But it is possible, and certainly you should kind of get things in line appropriately before it's too late for somebody. Of course, can't do this for everybody. If they die in the middle of the night, you can't do a swap after somebody's dead, but you can do it with somebody, has a little bit of lead time.
And so, Ed, this is a real opportunity for the participants who may be in the lending business, bankers, to help out their clients to achieve this great capital gain step up, and also, maybe get an opportunity for a loan facility to help that client. So there's opportunity abounds with surf planning. And just as an aside,
Absolutely.
Ed and I wrote an article that's in the Daily Herald that was published, I believe, on Sunday on this. We had a little bit of fun with that article, but the surf planning is explained there also.
We may have, there's some congressional proposals to limit crime powers and the crime annual exclusion gift, as well as the applicable exclusion amount. Some of these House and Senate proposals that Andy had mentioned at the top of the hour, they could happen. And what are you going to do to fund larger ILETs that may require $100,000, $200,000 premiums? Nobody wants to pay 40, 50% gift tax or whatever it might be under a new law to fund an ILET premium. Remember, you can have if you're setting up a SLAT, you can have your ILET be a beneficiary of the SLAT. And that way, if you funded this ILET ahead of time and Congress does muck with the tax law and you've got these ILETs, you've got to fund this, life insurance for business succession planning or estate equalization, you've got an extra backup solution in the SLAT to fund the ILET premiums. So that's another kind of thing that we look for and we put into our SLATs at K&H, which are a little bit more unique. And kind of brings us up to the end. Did we have any questions? Any conclusions and thoughts, Bob, Andy?
I got the same question 3 times. So the question was, if I already have a SLAT or an irrevocable trust, are there ways to update it to incorporate, what we're talking about here on the webinar? And the short answer to that is, it depends on what the trust says, but generally speaking, through decanting, trust protector, or otherwise, there are likely ways to update even an irrevocable trust or an older SLAT or an ILET that owns some life insurance to accomplish what we've talked about here today. If it was a trust that K&H drafted, then almost assuredly there's a way to figure it out. If it's something we haven't drafted, we'd be happy to take a look at that for anybody on the call, or just give your general thoughts on if you have an existing client's documents, you don't know if this could be applicable or if they can be updated in a certain manner, or maybe we just create new versions. We very likely can come up with a solution. So thank you very much, everybody, for attending today.
Thanks, everyone. Thank you, Bob, Andy, and Ed, for your presentation. Please reach out to any of our presenters if you have additional questions about our topic today. Their contact information is on the screen.
And we also have a wonderful YouTube channel for other topics, including estate planning topics. Just want to make sure we tout the YouTube work that Amy does such a great job with. So thank you, Amy.
Great. Thank you, everyone.
Thanks, everybody.